you only get 12 months to undo your Social Security decision. After that, you're locked in for life. But what happens if you pick the wrong strategy? Most people don't even realize they've made a mistake until it's too late. So in today's video, I'm going to show you the critical things you need to know before filing for Social Security, because once you file, there's no going back. I've analyzed hundreds of Social Security claiming strategies over the years, and I've seen how the wrong filing decision can impact everything from your lifetime income, to your taxes, to your Medicare premiums, and even your spouse's benefits. And most people make this decision without a plan, and the consequences can last for 30 years or more. So before you lock yourself into something permanent, let's walk through the biggest mistakes to avoid and how to build a strategy that maximizes your retirement income. So let's get right into the video. Here's the thing I've noticed over the years after running countless retirement plans is that almost everybody already has an age in mind of when they're going to take Social Security. Some people are convinced that they're going to wait until 70 no matter what because, that gives you the maximum benefit. Others are just planning to take it when they retire, which is often 65, which at that age too happen to be just kind of arbitrary, or, maybe that's because Medicare starts at 65. But what's wild is that almost no one looks at this decision in the full context of their financial plan. They haven't thought through the tax implications, the impact on their spouse, or what it means for the long-term sustainability of their income. And in most cases, they have no idea how permanent this decision really is. So, first thing we want to start with is the timing. If you file your Social Security at age 62, you're only going to get 70% of your full benefit. And that's the minimum, and it's locked in for life outside of, regular cost of living adjustments. But if you wait until your full retirement age, which is generally 66, mostly about 67 now, depends on your birth year, you're going to get 100% of your benefit. And then if you wait a further 3 years until age 70, your benefit grows by about 8% per year, up to 132% of your full benefit. So the difference between claiming at 62 versus 70 can be huge, right? For a high earner, waiting those extra years can result in about $182,000 in additional lifetime benefits, according to this Kiplinger article on Social Security. And this decision is not something that you can just go back and fix. So the Social Security Administration gives you only 12 months to withdraw your application. And even if you do, you have to go back and repay every dollar that you received into it if that's the decision that you want to make. After that, after the 12 months, your decision is permanent, and your monthly benefit, cost of living expenses, your survivor benefit, everything is going to be based on the age that you filed. And while timing on its own is a big decision, what I think most couples get tripped up on is when they fail to coordinate benefits. And that's where the spousal strategies come in. And that's where married couples leave thousands of dollars on the table without even realizing it. So most people know that Social Security offers spousal benefits, but what they don't realize is how easy it is to screw up the timing and miss out on thousands of dollars every year for the rest of their lives. So here's how it works. If you're married, one spouse can claim up to 50% of the other spouse's benefit, but only if the higher earning spouse has already filed. So I'll give you an example here. Let's say that your benefit is $2,500 a month and your spouse's is only $800. If you've already filed, they can claim a spousal benefit worth $1,250 every month instead of that $800. So that's an extra $450 a month in household income. And now here's where the trap comes in. If your spouse files early, like, let's say 62, that spousal benefit gets permanently reduced. So instead of 50%, it could drop to as low as 32.5%, and that reduction lasts for life. And look, guys, I've seen couples miss out on $500 to $1,000 a month, not because they didn't qualify, but because they didn't coordinate. And, one filed too early and the other didn't know the rules. And then, there's no going back. And so I think the question for you is, why does this matter? Well, the right strategy usually involves staggered filing. So sometimes it makes sense for one spouse to file early and the other to delay. Other times, waiting one extra year can unlock thousands of dollars in additional income. I mean, you saw the example I gave earlier in the video about a high earner. And don't forget that this doesn't just impact your monthly checks. It also plays into your survivor benefits. And this is a big deal because once one spouse dies, the larger benefit is the one that's going to continue. And that means it's often the higher earner who should delay filing. So you should really pay attention to that, because even if they don't need the income right away, you have to think, my spouse is going to get this higher benefit if I wait. So coordinating spousal benefits is key. But what really drives the long-term impact is what happens when one spouse passes away. And that's why, survivor benefit planning is so important, especially with couples that have a big income gap, right? If you guys had pretty similar lifetime earnings, it's not going to play as big of a role. But this is a part that almost nobody thinks about until it's too late. And if you're the higher earner in the household, your filing decision doesn't just affect your income while you're alive. It directly affects what your spouse receives after you're gone. Because when one spouse dies, the surviving spouse gets the larger of the two benefits. And that means if you locked in a low monthly benefit by filing early, your spouse is now stuck with that lower amount for the rest of their life. But if you delay until age 70, that benefit could be up to 32% higher than what you would get at full retirement age. And that higher number continues as a survivor benefit, potentially for decades. And I know it's hard to delay income, especially when you've just retired and that monthly check looks pretty tempting. I mean, there's a lot of anxiety about not getting a check anymore. So a lot of people, when they do retire early, they want to know they've got some guaranteed income coming in. It's just human nature. But this is one of those decisions that has long-term consequences, especially if your spouse outlives you by 10 or 20 years. And look, I mean, let's be honest. Statistically, that's exactly what happens in a lot of households. Maybe not 10 or 20 years, but women do tend to outlive men, and just, for societal reasons and so on. I mean, men tended to be higher earners, especially, in the current generation with baby boomers and even a bit of Gen X and, I guess even younger generations too. But the gap obviously is a lot closer now. But in any event, while most people focus on how Social Security impacts them today, I think the smart move is to ask, what will this decision mean for my spouse 10 or even 20 years from now? And so now that you understand these critical considerations, look in the description below where you can fill out a questionnaire, and I'll send you a video analyzing your specific situation and show you how to maximize your Social Security strategy given your situation. But now back to the video. So one of the surprises for a lot of people, especially those who retire but then continue to maybe work part-time through consulting or something like that, is that if you take Social Security before your full retirement age and you keep working, there's a penalty. So in 2025, if you earn more than $23,400, you lose $1 in benefits for every $2 you earn above that limit. So let's say you earn $35,000 from part-time work. That's $11,600 over the limit, which means Social Security will withhold $5,800 from your benefits that year. And to be clear, those lost benefits aren't completely gone. Once you hit full retirement age, your monthly benefit gets recalculated, so you do get some of that back. But that doesn't help you when you're staring at a missing check next month. And, it's a real cash flow problem. And for many people, it's an expensive one. And so, the earnings test only applies to earned income. So things like W-2 wages, from like a regular salary job, or self-employment income, or 1099 consulting work, it doesn't apply to pensions or investment income or like IRA or 401k withdrawals. But here's the catch. A lot of people take Social Security early because they retired and then go back to work part-time, and maybe it's just for 15 or 20 hours a week, but that income adds up fast, and before they know it, their benefits are getting clawed back. And with the earnings limit barely adjusting each year, I mean, gosh, it's been that amount since I can remember. More and more people are getting caught by this, especially younger retirees in their early 60s. And if the earnings test wasn't bad enough, here comes the double whammy, which is a lot of people are shocked to learn that Social Security is also taxable, and that tax bill can be bigger than you think. You probably think you've already paid enough taxes, but apparently not, because if you make enough money, even your Social Security check is going to get taxed. And this is one of the biggest surprises for new retirees. They think that once they're done working, the tax pain is over, but the truth is that up to 85% of your Social Security benefits can be taxed, and the thresholds that trigger those taxes are incredibly outdated. So here's how this works. The IRS uses something called provisional income to determine how much of your benefits are taxable. And what that includes is half of your Social Security benefits plus all of your other income. So think pensions, IRA withdrawals, dividends, even tax-exempt interest. And if your provisional income is over $25,000 as a single filer or $32,000 as a married couple, part of your Social Security becomes taxable. And if you go above $34,000 as a single filer or $44,000 if you're married filing jointly, now you're going to pay taxes on up to 85% of your benefit. And, these income limits haven't been adjusted since 1984. And meanwhile, the number of retirees who pay taxes on their Social Security grows every year. And in fact, according to the IRS, about 40% of beneficiaries are already paying taxes on their benefits. And that number just keeps climbing every year. And here's where it really stinks, I think, is that the taxation can push you into a higher bracket faster than you expected, especially if you have like pensions and IRA withdrawals and things like that. So, you could even have a modest income on paper, but when half your Social Security is added to the mix, your effective tax rate really starts to snowball. And that's why smart tax planning matters just as much in retirement as it does when you're working, because if you're not coordinating your withdrawals and your income sources carefully, you could end up giving back a big chunk of your benefits to the IRS. Now, we've talked about how the timing of your Social Security affects your benefits and your taxes, but the other area that I think people need to be more aware of is how it impacts your Medicare premiums. So, now look, let me be clear, right? This isn't a reason to not delay Social Security. In fact, for higher earners, delaying is often still the right move, but it's something you have to coordinate carefully, or you could end up paying more than you expected for healthcare in retirement. And here's why. It's because your Medicare Part B and Part D premiums are based on your income from 2 years ago. So if you file for Social Security and start drawing more income from your retirement accounts around the same time, so you've got IRA withdrawals or 401k withdrawals, or maybe even required minimum distributions, your income can spike, and so could your Medicare premiums. These surcharges are called IRMA, and that stands for Income-Related Monthly Adjustment Amounts. And guys, if you're a really high earner, they could add thousands of dollars per year in increased healthcare costs. And so here's where strategy comes in. You could use Roth conversions before RMD age to reduce future taxable income. You can manage withdrawals from taxable and pre-tax accounts, and you can coordinate your filing strategy to smooth out income across the board. And this is about looking at the full picture, not just how much your Social Security check is, but what it means for your net retirement income after taxes and healthcare costs. All right, so now that you've learned what you must know before filing for Social Security, let's look at how you can implement this advice into your retirement plan. At this point, you've seen how complex Social Security really is. The timing decision, spousal coordination, survivor benefits, taxes, Medicare premiums, they're all connected, right? So how do you make the right call? Well, I think the answer is simple. You build a strategy before you file. And we're going to go over what this looks like. So first off, you start by comparing your lifetime benefit projections for different filing ages using the Social Security estimator. You layer in your spousal and survivor benefits to see how different combinations affect your total household income over time. And then you analyze how your Social Security strategy interacts with things like Roth conversions, IRA withdrawals, taxable accounts. And then finally, you factor in the earnings test, tax thresholds, and IRMA brackets to make sure you're not triggering unnecessary reductions. Now, my advice to you is use financial planning software that's going to estimate all of this stuff for you. And any good software is going to estimate the taxes, it's going to estimate IRMA, and it's going to look at your whole picture from portfolio withdrawals and everything, so you get a complete picture of your net cash flows. Now, that's the technical side, right? But what really matters is the big picture, right? What's your net income over time? And then what happens to your plan if your spouse lives longer than expected or passes away earlier? What do your tax-adjusted ending asset values look like at different life expectancies? This is where everything comes into play. And this is how, I approach it with every plan that I build. And for all of you guys out there who are do-it-yourselfers, this is how I think you should approach it too. Something else that I like to look at, right? Because like I said, I don't want to only just look at lifetime income. I also want to measure, okay, what were the Monte Carlo results? What were the ending asset values? And what were their survivor scenarios, right? What if a spouse does pass away early and the lower earning spouse has to live? Because that's what's going to give you confidence that your strategy is built to last. So if you're thinking about filing, don't just default to 62 or 65 or even 70 without running these numbers and thinking about the big picture, because the decision is too important and too permanent to make in isolation. So now that you understand the critical things that you must know before filing for Social Security and how these irreversible decisions can affect your lifetime benefits by tens of thousands of dollars, you can make informed filing decisions that maximize your retirement security. And if you want help analyzing your specific Social Security situation and ensuring that you make optimal filing decisions, fill out the questionnaire in the description and I'll send you a video analyzing your circumstances and show you the optimal way to plan your dream retirement. Thanks for watching, and I'll see you in the next video.